In this video, we're going to talk about municipal bonds, which are also known as muni bonds, and it's just abbreviated MUNI. So muni bonds are debt that is issued by a state or a local government. Now, when I say a state, I'm not talking about a sovereign state, like, for example, the state of Greece or something like that. I'm talking about a state, for example, within the United States of America, like Illinois, Louisiana, and so forth. When we talk about local government, well, that could mean a town. It could mean any number of things. So municipalities and the muni bonds that they come from could be a city, could be a county, a publicly owned utility like waterworks or something, a school district even, or sometimes special taxing districts. And there are actually a lot more examples. This just gives you kind of an idea for the types of things that you would expect to issue a municipal bond. So when we think about some characteristics of municipal bonds, we can really break them out into three different types of bonds. One is what's called a general obligation bond. And a general obligation bond is basically backed by the taxing authority. So we'll just say backed by the power to tax. So when we say that, what we're saying is this. When this municipality, let's say it's a county, and they issue a general obligation municipal bond. When they do that, what they're saying is, look, we are backing this bond with our power to tax our citizens in our county. For example, if we cannot raise the money to pay this bond, we will raise our property taxes in order to get the money to make the debt service payments, right? To pay the interest, to pay back the face value. So that's what the general obligation bond is. It's one of the strongest types of municipal bonds. It's stronger than a revenue bond, where a revenue bond is actually saying, look, what we're pledging is going to come from a very specific revenue stream. And when I say revenue stream, what I'm talking about is, instead of them just saying, look, if we can't come up with the money, we'll tax our citizens more, we'll increase property tax. Instead of saying that, you're saying, look, we're going to tie this bond, this municipal bond, to a very specific source of income that the county or the city has. And what that could be is that they're building a highway. And they say, look, we're going to make this a toll road, and then we're going to get income from the tolls that people pay when they use this highway. And then that toll, that's going to be where we're going to come up with a revenue stream to pay back the bond. So it's a little riskier than a general obligation bond, because you could have an issue if, for example, they don't generate the amount of toll income that they thought they were going to be, or that they thought they were going to generate, and then in that case the bondholders could actually end up being hurt. And a pre-refunded bond is basically, it's a little more complex. We're going to have a specific video on it. It's basically when the municipality or organization decides that they want to refinance, and when they refinance, they're actually going to buy U.S. Treasury bonds. And so these U.S. Treasury bonds are actually going to back the old bond issue. And if that sounds complicated, just take a look at the other video we're going to do. I don't want to go into too much depth here on that. So another feature of municipal bonds is that they could be insured or they could not be insured. So when they're insured, it could be that the state, for example, just let's say you're buying a municipal bond from the state of Illinois, could be that the state of Illinois actually insures it offers to insure its bonds and might have a lower yield on the bond because it's insured or so. But it doesn't have to do that. Some states might not even offer that. It might be that, for example, you have a private organization from which you can purchase insurance. Now, that doesn't mean that the bond is still risk-free, right? Because this private organization, even though they're selling you insurance on that bond, what if they become defunct? What if they have a problem? So municipal bonds, in many cases, are what's known as callable. And so what callable is it's basically giving the organization that issued the bond the chance to buy back that bond at a certain price at some point in the future. So, for example, it might be that they issue a 30-year bond, but they say it's callable at year 10, right? So 10 years in, they can buy back those bonds. Now, you might say, why would this organization want to buy back the bonds? Well, it could be that interest rates have declined, right? So interest rates have declined. Maybe they issued at 6%. Now interest rates are 3.5%. And so they say, hey, you know what? Let's buy back this bond because we can issue bonds now at a much cheaper rate. And so when a bond is callable, that's actually going to have more risk for the person buying the bond. So one of the most important features, though, of municipal bonds is that many of them, most of them, in fact, are tax exempt. And when I'm talking about tax exempt, I'm talking about federal and then state and local tax, right? So federal tax is actually going to be dependent on what the bond is actually used for, right? Is it used for something that's kind of like a necessary use, or is it used to build a football stadium? So in some cases, a municipal bond could actually not be exempt from federal income taxes, but in most cases they are tax exempt. So people usually just think of muni bonds as being tax exempt. And then when you think about state and local taxes, typically if you buy a municipal bond in Illinois, then Illinois state tax is not going to charge you for that. However, states sometimes do tax bonds, the municipal bonds from other states. So it's important to check with your state. But when we think of municipal bonds in general, the most important feature, the most common feature that comes to mind when you talk about municipal bonds is that they're tax exempt. And so because they're tax exempt, they're actually going to be a very attractive investment vehicle for investors that have very high income. If you're in a very high tax bracket, then it's going to be very important for you to have municipal bonds in your portfolio. And to kind of think about why, I'm going to have another video where we specifically talk about this in depth, but I just want to give you a quick kind of idea. So let's say that you had a municipal bond, a muni, that was tax exempt, right? Exempt from federal tax, state tax, local tax, right? Just a plain vanilla municipal bond that is tax exempt. So if we think about the return, let's say it's a $1,000 bond. Okay, when we think about, let's say it's a $1,000 bond, and let's say that you're in the 39% tax bracket, right? Life is going wonderful for you. You're in the 39% bracket. And so you're going to earn, after, let's say it's 1 year's interest, it pays annually. So you get $40 interest, right, for a 4% municipal bond. But for a 4.5% corporate bond, right, so it's got a higher yield than this municipal bond, you're going to get $45 interest. So you might say, hey, wait a minute, this 4.5% corporate bond is better than the 4% municipal bond. But remember, you have to pay tax on that corporate bond, whereas the municipal bond, the tax is zero, right, because we said it's tax exempt. So assuming you're at the 39% tax bracket, you're going to have $17.55 tax on this $45 of interest you earned if you buy the corporate bond. And so what that means is, and let me just change color. So our after-tax income for the municipal bond is going to be $40, but for the corporate bond, it's only going to be $27.45. And all I did there was I just took the interest for the corporate bond and subtracted out the tax you have to pay. So because you're in this 39% tax bracket, this really high tax bracket, you are actually giving away a lot of interest, or a lot of that interest, back to the government in form of taxes if you do the corporate bond. So even though the municipal bond has a lower rate of interest, it actually, when you think after tax, you're getting $40 instead of $27.45. So that's a really big difference. So now you might say, well, hey, why you say it's just better for high income people? What about, somebody who's low income? I mean, they still have to pay taxes, right? Well, it depends. So even if they're paying taxes, so let's just say for a minute, let's say instead of the 39% tax bracket, let's say that someone was at the 10% tax bracket. Okay? So now if they're at the 10% tax bracket, for the municipal bond, they're still going to have the same, everything's the same, right? You still have no tax, so you're tax exempt. It doesn't matter what the tax bracket is. So you still have $40 of after-tax income. However, now for the 4.5% corporate bond, you're going to have a tax. It's not going to be $17.55. Now it's going to be $4.50. Let me change, make that red, so we'll just make it $4.50 tax, right? Now, we take 45 minus the $4.50, right? And that's going to give us, instead of $27.45, now you're going to have $40.50. So you see now that actually the return from holding the corporate bond is higher than the after-tax income from the municipal bond. So you say, hey, wait a minute, we really didn't change any, kind of the statistics or whatever, the details of this bond. all we did was change what that person's tax rate was, what the tax bracket they were in. So based on this, we can tell that all else equal, the higher the tax bracket you're in, the more attractive municipal bonds are going to be, because that's going to be that much more important that you maximize your after-tax income instead of just thinking about your pre